The week ends with more disappointment for pound lovers. Now, the pound failed to recover the October 7th flash crash, the 122.95 level, which is the major 38.2% retracement on the flash crash, sheltered offers, as the pound dollar dampened to 120.88 on October the 11th. The deep downside potential in the pound continues to scare investors who hesitate to jump in for a recovery. Of course, the recent sell-offs have been so aggressive that cable lacks sustainable momentum on the upside. With easing tensions, we could expect the pound buyers to return back into the market once they are convinced that the US dollar appetite has come to exhaustion. We have a light economic calendar in the US next week. US inflation will be the major macro data. Now, the year-on-year figure for September is expected to have accelerated to 1.5% from 1.1%, with core inflation ex food and energy stable at 2.3%. Now, a solid inflation read would of course give a further hand to the Fed hawks. Yet the US dollar will certainly be facing political risks and temporary unwinds walking into the presidential election on November the 8th. In this respect, the Fed's November meeting will certainly be left aside. Now, market expectations for a December rate hike from the Fed is currently 65% at the time of recording. Given the slow data flow in the US, traders' attention will shift to the Eurozone. The European Central Bank will meet on Thursday, October the 20th. The ECB is expected to hold fire at this meeting, but the accompanying statement will be the main focus as markets are waiting for the solution for the ECB to be able to expand its QE programme beyond March 2017. Now, in order to continue buying 80 billion euros worth of assets on a monthly basis, the ECB will need to revise the game's rules. Among solutions, analysts cite the possibility that the ECB could allow buying sovereign bonds yielding below the deposit rate, which would allow the ECB to tap into German bonds. The ECB could decide to modify the capital ratio, meaning that countries with more debt would have a higher allocation. Although such modification would bring along a political turmoil within the Eurozone countries, as of course little indebted countries as Germany would find it unfair that the more indebted countries such as Spain and Italy would be benefiting more from the ECB support. Finally, the ECB could decide to increase its individual asset allocation, which in our view appears to be the less politically complex option. We remind that similar expectations were built before the ECB's recent meetings and resulted in sizable market disappointment. Anyhow, the majority of analysts do not expect any concrete action at the October 20th meeting, yet expect a concrete schedule for steps to be made at December's meeting. LCG's Ipek Ozkar-Deşke says that the ECB needs to give a signal on what may happen in the future, to give the market some time to readjust its positioning, without generating a new wave of panic before the year-end holidays. Finally, the minor recovery we've seen in gold has failed to generate enough momentum, and the 200-day moving average at 1,275 remains the key midterm resistance, especially given the improvement in US yields on the back of a steeper Fed outlook, despite quite a challenging political environment in the US. That's all, folks. Now make sure you stay up to date with all the latest technical analysis and market insights on lcg.com/analysis. Have a great weekend and goodbye.